What's up guys, it's Playing for Keeps here. Today we're going to be going over fair value gaps or FVGs. So what is a FVG? Fair value gap is a concept in SMC or ICT trading that refers to a range in price delivery where only one side of the market liquidity is offered. So what do we mean by that? We have a bullish candle here, right? An up close candle. So as you can see, only buy side is offered. And we can see this by the identification. So it can be identified on any time frame by looking at a candle, the candle prior, and the candle after. And specifically the wicks of the candles before and after. So we have this bullish candle here. The candle before, the buy side wick ends here. The candle after, the sell side wick ends here. So this whole range in between is a fair value gap. And it's called that because literally fair value is not offered. So it was not fair how this candle went up like that and did not give enough sell side action to traders. So why are fair value gaps important? So fair value gaps identify areas where price is likely to return to find fair value. So fair value was not offered, correct? So the market is going to be attracted to these areas to offer fair value to traders. So they act as magnets. That makes them potent entry points, exit points, and indicators of market bias. So we'll get into the midpoint next. So I want to go over this example here. We have a fair value gap marked out. It is a bullish fair value gap, as you can see by the up close candle, the candle after, and the candle before. The wicks do not touch. So the midpoint that we were referencing, this midpoint here, called the CE, this would be considered discount. This would be considered premium. So when using them as a long entry, you want the price to come into discount, ideally, and then you want to take the trade long. You would be targeting some liquidity here, but that's for another video. So yeah, bullish fair value gap. These will be referenced as BISIs, which means buy side imbalance, sell side inefficiency. And yeah, that's what I call them in my TA and what many will call them. So we have another example here. This is a bearish fair value gap, which will be known as a SIBI, sell side imbalance, buy side inefficiency. So I wanted to show you guys this example because price is not always going to come past that midpoint, but they can still be valid entries. So ideally, we would have wanted to see price come into premium here, but as you can see, it did not. So it's not always 100%, but we have other methods to make them more precise, such as models, and yeah. But these are the basics. We got the basics down. So I hope you guys thoroughly understand this, as in why they happen and why they're important. So the market is basically just, it's being fair. So too much sell side was offered. It needs to come back, offer fair value, and then continue on with its objective, which was bearish. So these are going to be really important, guys. It's really important for you to know and thoroughly understand.
Yeah, hello.